These are Medicare surcharges in 2026 that will quietly drain thousands from your retirement savings if your income crosses specific thresholds. The Income-Related Monthly Adjustment Amount, or IRMAA, hits Medicare beneficiaries harder than ever before, with premium increases of nearly 10% and a 2-year income lag that catches retirees completely off guard. If you're planning for Medicare in 2026 or already enrolled, you need to understand how this surcharge works because it operates like a financial cliff. Cross the income threshold by just $1, and you'll trigger surcharges that can add hundreds of dollars to your monthly Medicare premiums. What's even more concerning is that most beneficiaries don't realize they have appeal rights that could save them thousands of dollars annually. IRMAA stands for Income-Related Monthly Adjustment Amount, and it's essentially a penalty surcharge applied to your Medicare Part B and Part D premiums if your income exceeds specific thresholds. The Social Security Administration determines whether you owe this surcharge based on your modified adjusted gross income from 2 years prior to when you actually pay the surcharge. Here's where it gets tricky and why so many people get blindsided by these charges. The income that determines your 2026 IRMAA surcharge comes from your 2024 tax return. So right now, as we're heading into 2026, Medicare looks at what you earned in 2024 to decide how much extra you'll pay for your Medicare premiums this year. This 2-year lag creates a situation where retirees who had high income years in 2024 but have since retired or reduced their income still pay premium surcharges based on their old, higher earnings. The financial impact grows substantially. For 2026, the standard Medicare Part B premium increased to $202.90 per month, which represents a $17.90 increase from 2025's premium of $185. That's nearly a 10% jump in just 1 year. But if you're subject to IRMAA surcharges, your actual premium could be anywhere from $284.10 to $689.90 per month for Part B alone. Let's look at exactly how these income thresholds work for single filers. If you're single and your 2024 income was $109,000 or less, you pay the standard premium with no surcharge. But if your income exceeded $109,000, even by just $1, you immediately jump to the next tier and pay an additional $81.20 per month in surcharges, bringing your total Part B premium to $284.10. The surcharge tiers continue to escalate dramatically. Single filers with income between $137,000 and $171,000 pay an additional $202.90 per month in surcharges. Those earning between $171,000 and $205,000 face surcharges of $324.60 per month. The fourth tier, covering income from $205,000 to $500,000, adds $446.30 to your monthly premium. And if your income reached $500,000 or more, you're paying the maximum surcharge of $487 per month on top of the standard premium. For married couples filing jointly, the thresholds double the single filer amounts. The initial threshold is $218,000, and the tiers progress through $274,000, $342,000, $410,000, and finally $750,000. But here's where IRMAA creates a particularly unfair situation that affects many married couples. If you're married but file separately, you face a severe penalty structure that can cost you thousands of dollars annually. Married couples who file separately use the same income thresholds as single filers, but with a twist that makes the surcharges much more punitive. While single filers have 5 distinct income tiers with graduated surcharges, married filing separately individuals face a compressed structure. If your individual income on a separate return exceeds $109,000, you immediately jump to paying $446.30 in monthly surcharges. You only avoid the maximum surcharge if your income stays below $391,000. This creates an enormous penalty for couples who might have legitimate reasons to file separately, such as significant medical expenses, different business structures, or estate planning considerations. A couple with combined income of $300,000 filing jointly would pay $81.20 per month in IRMAA surcharges. But if they filed separately with $150,000 each, they would each pay $446.30 per month in surcharges, more than quintupling their IRMAA costs. The surcharges don't stop with Part B. Medicare Part D prescription drug coverage also carries IRMAA surcharges using the same income thresholds. For 2026, Part D surcharges range from $14.50 to $91 per month, depending on your income tier. When you combine Part B and Part D surcharges, high-income beneficiaries can pay an additional $578 per month in IRMAA charges beyond their standard Medicare premiums. What makes these 2026 increases particularly concerning is the rate of growth in both premiums and surcharges. While the IRMAA income brackets increased by approximately 3% due to inflation adjustments, the actual surcharge amounts increased by approximately 9%. This means that even if your income grew modestly with inflation, you're still facing disproportionately higher Medicare costs. The Part B premium increase alone represents a significant burden for many beneficiaries. That $17.90 monthly increase adds up to $214.80 annually, and this affects every Medicare beneficiary, not just those subject to IRMAA. The Medicare Part B deductible also increased by $26 to $283 annually, representing a 10.1% increase from 2025. According to the Centers for Medicare and Medicaid Services, this premium increase reflects projected price changes and utilization increases consistent with historical trends. However, there's an interesting policy detail that affected the 2026 rates. CMS noted that due to changes in the 2026 Physician Fee Schedule Final Rule, spending on skin substitutes is expected to drop by 90%. Without administrative action to address what they called previously unprecedented spending on skin substitutes, the Part B premium increase would have been approximately $11 higher per month. Understanding how your modified adjusted gross income gets calculated for IRMAA purposes becomes crucial because it's not the same as your regular adjusted gross income. MAGI for IRMAA takes your AGI and adds back certain types of income that were excluded, including tax-exempt interest income. This means if you have municipal bonds or other tax-exempt investments, those earnings count toward your IRMAA threshold even though they don't appear in your regular AGI calculation. This MAGI calculation catches many retirees by surprise. You might think you're safely below the IRMAA thresholds based on your AGI, only to discover that your tax-exempt bond interest pushed you over the limit. It's particularly problematic for retirees who chose municipal bonds specifically for their tax advantages, not realizing those advantages would be partially offset by higher Medicare premiums. The 2-year lag in IRMAA calculations creates both challenges and opportunities for tax planning. Since your 2026 IRMAA is based on your 2024 income, there's nothing you can do now to change your 2026 surcharges. However, you can start planning for 2027 and beyond by managing your 2025 income strategically. This lag system creates particularly difficult situations for people who had one-time income events in 2024. Maybe you sold a business, took a large IRA distribution, exercised stock options, or had significant capital gains. Even though that income event is in the past and your ongoing income is much lower, you'll pay IRMAA surcharges for 2 years based on that temporary income spike. Here's where most people don't know about their rights. Medicare provides an appeals process for IRMAA determinations, but the vast majority of beneficiaries never use it. You can appeal your IRMAA surcharge if you've experienced what Medicare calls a life-changing event that significantly reduced your income. Life-changing events that qualify for IRMAA appeals include retirement, reduction in work hours, loss of pension income, death of a spouse, divorce, or natural disasters that affected your income-producing property. If you can demonstrate that your current income is significantly lower than what appears on your tax return from 2 years ago, you may qualify to have your IRMAA surcharge reduced or eliminated. The appeals process requires you to contact Social Security and provide documentation of your life-changing event and current income situation. You'll need to complete Form SSA 44, which is the Medicare Income-Related Monthly Adjustment Amount Appeal Request Form. This form allows you to explain your circumstances and provide evidence that your income has decreased from the levels shown on the tax return being used for your IRMAA calculation. What's particularly important to understand is that successful appeals result in immediate premium reductions. If your appeal gets approved, the lower premium rate typically takes effect the month after Social Security processes your request. You may also receive retroactive adjustments if you've been overpaying premiums for several months while your appeal was pending. The appeals process becomes even more valuable when you consider the cumulative cost impact. Let's say you're a single filer who had $180,000 in income in 2024 due to a one-time business sale, but your ongoing retirement income is only $80,000. Without an appeal, you'd pay $324.60 per month in Part B IRMAA surcharges and $60.40 per month in Part D surcharges, totaling $385 in monthly surcharges or $4,620 annually. A successful appeal could eliminate these surcharges entirely, saving you thousands of dollars. The freeze on the highest income tier represents another important policy consideration for high-earning beneficiaries. Currently, the first 4 IRMAA income brackets get indexed for inflation annually, which means they increase each year to account for rising costs. However, the 5th bracket covering the highest incomes is frozen and cannot be indexed for inflation until 2028 at the earliest. This freeze means that high-income earners may find themselves subject to IRMAA surcharges at progressively lower relative income levels as inflation continues. While their absolute income thresholds remain the same, the real purchasing power of those thresholds decreases each year, effectively expanding the reach of the highest IRMAA tier over time. For couples considering their filing status, the married filing separately penalty deserves careful analysis. While there are legitimate reasons to file separately, the IRMAA implications can be severe. Before choosing separate filing status, couples should calculate not just their income tax differences but also the potential multi-year impact of higher IRMAA surcharges. The cliff effect nature of IRMAA surcharges creates some counterintuitive planning situations. Since crossing an income threshold by even $1 triggers the full surcharge for that tier, there can be scenarios where earning slightly less money actually results in significantly higher after-tax, after Medicare premium income. Consider a single retiree with $109,001 in MAGI. That extra dollar over the threshold costs them $974.40 annually in additional Part B surcharges and $174 in Part D surcharges, for a total annual cost of $1,148.40. From a financial planning perspective, it might make sense for this person to contribute that extra dollar to charity, make additional IRA contributions, or find other ways to reduce their MAGI below the threshold. This creates opportunities for strategic income management in retirement. Techniques like charitable giving, qualified charitable distributions from IRAs, timing of asset sales, and careful management of retirement account withdrawals can help keep income below IRMAA thresholds. However, these strategies require planning and often involve trade-offs that need careful evaluation. The interaction between IRMAA and required minimum distributions from retirement accounts creates particular challenges for many retirees. RMDs begin at age 73 for most people, and these mandatory withdrawals can push previously comfortable retirees over IRMAA thresholds. Since RMDs generally increase each year based on account balances and shortened life expectancy tables, the IRMAA impact often worsens over time. Some retirees find that Roth IRA conversions earlier in retirement, before they're subject to RMDs, can help manage long-term IRMAA exposure. While Roth conversions increase income in the year of conversion, potentially triggering IRMAA surcharges temporarily, they reduce future RMD obligations and can result in lower lifetime IRMAA costs. The timing of Social Security benefits also factors into IRMAA planning. Social Security benefits count toward MAGI for IRMAA purposes, so the decision of when to start benefits affects not just the benefit amount but also potential IRMAA exposure. Delaying Social Security to age 70 increases the monthly benefit amount but also increases the MAGI impact when benefits do begin. For those already enrolled in Medicare Advantage plans, it's important to understand that IRMAA surcharges still apply. Medicare Advantage enrollees pay the same Part B premiums and IRMAA surcharges as traditional Medicare beneficiaries, plus any additional premiums charged by their Medicare Advantage plan. The Part D IRMAA surcharges also apply to prescription drug coverage provided through Medicare Advantage plans. The geographic impact of IRMAA varies significantly across the country due to different costs of living. A $109,000 income in rural areas might provide a comfortable retirement lifestyle, while the same income in high-cost metropolitan areas might barely cover basic expenses. However, IRMAA thresholds remain the same nationwide, which means the relative burden falls more heavily on retirees in expensive areas who may not feel financially comfortable despite technically having high incomes. Looking ahead, the IRMAA system faces ongoing policy discussions about its structure and fairness. Some argue that the cliff effect creates arbitrary and punitive outcomes that discourage productive activity in retirement. Others contend that high-income beneficiaries should pay more for Medicare benefits as a matter of fairness to lower-income beneficiaries who subsidize the program through their tax contributions. The current trajectory suggests that IRMAA will continue to affect more beneficiaries over time. As the income thresholds increase more slowly than healthcare costs and general inflation, a growing percentage of Medicare beneficiaries may find themselves subject to these surcharges. The freeze on the highest income tier only accelerates this trend for high earners. For immediate planning purposes, beneficiaries should review their 2024 tax returns to project their 2026 IRMAA exposure and their 2025 income situation to plan for 2027. If you experienced a significant life change since filing your 2024 return that reduced your income, investigating the appeals process could result in substantial savings. The appeals process, while underutilized, represents one of the most important benefits available to Medicare beneficiaries facing IRMAA surcharges due to outdated income information. Given the potential savings of thousands of dollars annually, it's worth investigating whether your situation qualifies for an appeal, especially if you've retired, reduced your work hours, or experienced other significant income changes since the tax year being used for your IRMAA calculation. Understanding IRMAA isn't just about managing current Medicare costs, it's about making informed decisions throughout retirement that account for these ongoing premium obligations. As healthcare costs continue to rise and Medicare policy evolves, IRMAA represents a significant and growing component of retirement healthcare expenses that requires the same careful planning attention as other major retirement costs. The key takeaway is that IRMAA operates by different rules than most other retirement expenses. The 2-year lag, cliff effect, and appeals opportunities create a complex system that rewards understanding and planning while penalizing those who don't realize how it works. Whether you're approaching Medicare eligibility or already enrolled, taking time to understand these rules and plan accordingly can save you thousands of dollars and help ensure that Medicare premium costs don't undermine your retirement security.